Good evening, everyone, and welcome to the 14th session of the IAM Knowledge Series. Over the last 13 sessions, we've covered quite a range of topics, and some consistent questions we received from founders throughout the series were on fundraising. So what do investors look for? When should one raise capital? How to raise capital successfully? Among many others. So today's session will hopefully answer all your questions. We have kept ample time for question and answers as well today. So please start sending your questions via the Q&A tab at the bottom of your screen. And we will answer them as we go throughout the session. Now, since fundraising is quite a broad topic, this session will focus on equity financing. So that's when you raise capital from investors in exchange for shares in your company. And to answer all your queries, joining us today are Mr. Raman Roy and Samarth Agrawal. Mr. Raman Roy is the Chairman and Managing Director at Quattro, co-founder and board member, Indian Angel Network, co-founder and member of IN Fund. Mr. Raman is widely regarded as the pioneer and guru of the BPO industry in India. He is fondly referred to as the father of the Indian BPO industry. He has played a pivotal role over the last 30 years in shaping the global outsourcing space and promoting Indian BPOs and proving that India can be a preferred location for remote processing. Mr. Raman, with a guiding philosophy of enhancing the success rate of nascent businesses and creating an ecosystem for startups, is a founding member of the Indian Angel Network. He has made over 50 investments in startups and mentors over 20 companies. He sits on the Venture Capital Investment Committee, hosted by SIDBI for the distribution of the fund of funds by the Government of India, and is also the co-founder and member of IC of the IN Fund. Mr. Raman also sits on the board of Invest India, which is the National Investment Promotion and Facilitation Agency, and National Skill Development Council, NSDC. He is also on the board of TIE Delhi NCR and the Indian Angel Network, besides a select few companies of his investee companies. Now, along with Mr. Raman, we also have Samarth Agrawal, a successful entrepreneur who will give a founder's perspective on fundraising. Samarth is the co-founder and CEO of Max Wholesale, a B2B e-commerce company that helps Kirana stores place orders for inventory directly from brands, cutting the sourcing time to less than 24 hours. His clients include some of the largest FMCG companies in India, India's largest and most valuable online food ordering and delivery platform, some of the fastest growing grocery retail chains of Delhi NCR, and thousands of Kirana stores. As an accomplished Wall Street trader turned entrepreneur, Samarth has been associated with large brands like American Express, Lehman Brothers, and Societe Generale, where he led global teams in America, Europe, and Asia. Automated trading systems developed by Samarth captured daily market share of 2.5% of New York Stock Exchange's trading volume. A savvy programmer, Samarth is passionate about solving large problems with extraordinary impact at scale using technology as a crucible. Samarth holds a bachelor's degree in computer science and mathematics from IIT Delhi and a master's in financial engineering from Columbia University, New York. So welcome, Mr. Raman and Samarth. Thank you for your valuable time today.
Good afternoon, good evening, folks.
Hi, everybody. Thanks, Kanchi, for the introduction.
Lovely. So to begin, many times we speak to founders that might not need equity financing, and not all companies need to raise capital from investors via this route. So maybe Mr. Raman, if you could share some light and some insights on how should a founder actually evaluate whether they need to raise, capital via this format or not?
Well, it depends what you can do with the money. And, I have of late met a lot of founders who raise money for the sake of raising money because they are in their mind chasing a valuation game. And they just think that raising money will give them a valuation and their paper wealth will grow, so will that of their investors. But I think what is integral is for founders to evaluate what they will do with the money, what they need money for, and where they can take their company. And whether that can be a win-win for the company and therefore for its investors, and therefore for its employees, and therefore for its customers. But, seeking money for the sake of money, or it just doesn't make sense. Till the WeWork IPO, there was a lot of things happening in the marketplace globally, not only in India. India was perhaps a little bit of a lag behind, where people went for a raise of money for valuation to be able to add customers. I think WeWork made a very fundamental change in the marketplace to say, ultimately, we are in business to make profits. When will you become profitable? What will be your cash flow? What will be the valuation of the future cash flow? And that is the base driver. And I would urge all the founders who are logged in to look at it to say, why am I going to raise money? Because that is a question you will be asked within the first 2 minutes of meeting any investors. What will you do with the money? And if they are convinced that the money will add value to the company, that it will help take company to the next level, is where they will be supported.
Sure, thank you, Mr. Raman. Samarth,
Keep calling me Mr. Raman, and that doesn't work for me. So everybody within IIM calls me Raman. They also call me a lot of 4-letter words, which we will not use in this session, but Raman sounds very good.
Okay, it was just purely out of respect. I'll try my best, but in case I miss it, I'll go back to what I used to call you, Mr. Raman. So, Samarth, maybe when did you decide that, you needed to raise capital and reach out to investors? And, from your experience, when is the right time to approach investors, and how did you go about it? How did you approach investors?
So before he answers, in the spirit of full disclosure, I'd like all the attendees to know I am an investor in Samarth's company. I also sit on his board. So poor chap may be constrained not to tell some truths of what idiots investors are in this session, just because I'm also attending with him. But with that, Samarth, over to you.
Well, thanks, Raman. Thank you very much. Thanks, Kanchi. I believe, there is a lot of variables at play when a founder is trying to raise funds in the market from investors. Selling equity in your company to get access to money is one of the most expensive ways of getting funds, because that's something that's not going to come back to you as your equity in the company. You are losing ownership in your company. So there is a lot of different variables at play here. One of the most critical variable one has to look at is, what is the business plan, and what do you need the money for, and how much money do you envision needing for your business? So let's say you are an early stage startup, you have a business idea, and you have put some execution in place, right? Now, in order to have growth, mostly you need capital for growth. And when you are in the market looking for investors, looking for money for growth, the critical aspects to look at is, what's your business model? If you have, let's say, 8 months, eight quarters of projection, 2 years, 3 years of projection, and your business model says, I need X amount of dollars, I need $1 million or $2 million, or whatever that money the model is telling you that you need. Multiply that by, let's say, you increase that by 20%, 50%, and that's the amount of money that you need according to your model. Now, you also need to understand whether or not your business model allows you to get that kind of money. So if you have a good equilibrium in how much capital you need and how much capital your business numbers, your current stage of the business will allow you to raise, if there is a good match between the two, I think that's a good time to go to market and raise capital. It's also another thing I would request the founders to keep in mind is, which is my own learning, is that raising capital is not a 0-1 game. It's not black or white. It's not a true or false statement. There are a lot of different aspects of raising capital which are always at play. So you are almost constantly doing different things while building your company, while growing your company, which all add towards your eventual interaction with the investor. So if you look at the building your business and raising capital from that lens, you're almost always in a fundraising mode. However, it's not just visible, it's just that it's not visible outside the company.
Sure. Lovely, lovely. Thanks so much, Samarth. Mr. Raman, you've invested in over, yeah, I'll work on that. You've invested in over 50 companies. As an investor, most founders over and over ask us that, what do you look at? What goes on in the investor's mind? How do you evaluate startups? And also, building on that, what would you like to see a founder add to his pitch deck when he's applying to you? What parts of the pitch deck interest you most, and how do you evaluate that? Mr. Raman, you're on mute.
Okay, that seems like a very simple question at one level, but actually it's quite complex, because it's not one thing that I look for in an investee company, in the founders, in the pitch. And it is also very dynamic. It undergoes a change of what one is looking for. So at one point of time, in IAN, where I had invested in a company, somebody came and said, I didn't know you were interested in whatever, this space, and you invested it. I said, oh, no, I'm not invested in that. So no, I saw your name. You're in that. I said, oh yeah, that one. Oh yeah, I have. Said, then if you don't even know what space they are in, what did you invest in? Said, man, I love those founders. So, there are times you meet the founder and you resonate with the passion of that founder or the founding team. You resonate with the insight that they bring to what they are trying to do. And you say, I'm going with this team. And there are companies in which I've invested where people come back and pivot. And I'm happy for them to pivot because I love that team, because they will do what is right. They will do what is right for the company. So that particular aspect, about a month ago, I was chatting with Sanjeev Bichchandani, the founder of Naukri. A lot of the attendees would have heard of Naukri.com, perhaps one of the very, very, very few internet companies that are profitable. And we got down to discussing exactly the same thing, to what to look for in an investee company. And he articulated it very well. I think he did a far better job than I'm able to do on that, where he said, the founder must have some insight to the customer, something. And he narrated the story of how he formed Naukri, what he saw in Zomato when he invested in Zomato. Again, if we take a poll, I'm sure 90%, if not more, of the attendees have used Zomato sometime or the other in life. But what insight they have and what is the solution that they were trying to give. Also, another close friend in terms of raising money, Sanjeev Agrawal of Daksh. We used to be competitors. Spectramind and Daksh used to compete. And well, then he got into investing, and so did I. He invests through a fund that he manages for other people, and I invest as an angel and also through the IAN fund. One of the insights he brought out in another conversation is to say the best time to raise money is when the investor comes looking for you rather than you have to go looking for the investor, where your business is good enough that the investors want to be a part of it. One last thing, what do investors look for? Really, whether the investors look for it or not, from the founder's viewpoint, the customer's money is far, far, far better than the investor's money. And Samarth, in his opening comments, brought that out, that giving equity is the most expensive way you can get money. If you can get money, customers' money, because your business model is robust, there are repeat customers, customers come to you again and again, word of mouth expands your business, and you're getting customers' money, soon the investors will follow the customers to come in and give you the money. But customers' money is the mantra. Investor money is not the mantra, and that is what our attendees must understand. Over the last couple of years, I've seen a lot of founders think that investor money is the mantra. In my opinion, that is an error. Customer money is the mantra, investor money follows.
Lovely. Thank you. Thank you, Mr. Raman. Samarth, you've been there, done that, recently, where you've raised capital, multiple rounds actually. So, as a founder who successfully raised multiple rounds, what has your experience been with raising capital? What do you think worked? Are there any points that you wish you knew earlier before you started fundraising? And what are your suggestions to the investors that are looking to raise? Of course, customer money is, of course, very important, but take us through your journey as well. How did you go about it?
You're on mute, Samarth.
So yeah, absolutely. Sometimes you raise capital from an experienced investor in order to add credibility or validation to your business, right? So that is a huge plus side of having well-known, accredited, respected investors on your cap table in your business, is to you're able to not just scale your business, but also it enables you to attract talent. It enables you to attract people in your team, and if you have a good investor on your cap table, it enables you to get better customers, more customers, and you build an overall trust around your business. So from that perspective, it is good to sell some equity in your company and get good investors on your cap table. Another value that good investors bring in is that when they join your board, is they bring their experience as guidance for you to not make the mistakes that perhaps your investors are able to see that you might end up making because of their own experience, or because of the experience they get by having invested in a larger portfolio of companies. So they are probably learning from other founders who are making certain mistakes that you could avoid because you get that guidance from your investors, right? So those are a few other softer aspects that make it worth the effort, not just purely for the money. So my advice to the founders would be to look for investors, who bring that kind of value add to your cap table, who enable you to become a sort of an attractor of other participants in your growth journey, employees and customers and other key partners that you would want to work with, as well as get some guidance so that you avoid mistakes and you don't make stupid mistakes. You utilize your time more creatively and more efficiently. So those are the things that they should look for. And in my experience, I was lucky to have met some great investors who also joined my board. Raman is in this call. We have other investors who have joined my board, and they really help us out in every board meeting as to how to go about making certain decisions. So One thing that helps in doing all of this is a lot of networking. So I think that is one thing that the founders should definitely focus on is, you know, raising funds from an individual investor or trust with that individual investor or with the institutional investor or the fund that you are working with. To build that trust, it takes time. It takes months to build that trust. So it's important to start early, even if you are not really looking for capital at that particular point in time. It's good to meet potential investors. It's good to build relationships there. It's good to build a rapport with investors who you think like the domain that you are working in. So knowing your startup, if you, it's a good thing to research who are the investors who invest in the domain that I am building my startup in, who are the funds or the partners in the funds or individual early stage angel investors who take a bet or like the field that I'm working in, and start interacting with them. Use social media or cold emailing, or try to get some common connects and try and connect with the investor. Try and get a meeting, get their guidance, and build that rapport. And slowly you will get more and more success in your relationship building. And once that starts happening, the network will sort of start helping you raise the funds. So it's a longer process. It's not just about sending a deck to somebody, asking for a meeting, and then in the next meeting asking for some funds. Doesn't work that way. You need to build your relationships.
Lovely. And, once you have that meeting with the investor, I'm sure, many a times founders say, I need to connect over a call for me to even explain what my venture is all about. So how important do you think is the pitch deck, before they send it out to the investor? Or do you think they should directly what do you think? What was your experience with, sending a deck across, communicating about your business via a deck? And then speaking to an investor, because I do get asked many a times, and we get 11,000 applications a year. So to speak to all 11,000 founders in a year by a team would be humanly impossible, or we wouldn't be able to do as much justice over a call. So I know I request for a deck many a times before a call follows. And then a call follows. So well, how did you communicate and give justice to what your business was doing via deck?
Well, it depends on the stage of the company. Now, assuming that, we are largely, let's focus on the early stage companies. A deck is a way of communicating your idea and your journey, your story, your victories, your business plan in a very concise manner to somebody while you're not present there, right? So the deck solves a purpose of communicating the content that you want to communicate in a crisp manner without you being present in that room. So to that extent, it's very critical. It's very important for how would you measure the success of a deck? I think a good metric would be how many emails did you send, how many people did you share that deck with, and out of those, how many people agreed to get on a call with you or get on a meeting with you. So the purpose of a deck largely is to get to that first call, is to get you to that first meeting. And in an early stage setup, in a late stage, deck probably comes in the third or fourth meeting. Before that, it's all conversations. But in an early stage setup, try to make a deck which excites the investor enough for the investor to get on a call with you or agree to meet you once. And what excites investors? Having a large market to address, understanding the problem you're solving, your solution having some sort of an unfair advantage, or like Raman was saying, a very good customer insight in your deck, and some sort of execution already in place. If you have revenues, nothing like it. If you have, if a deck also shows the founder's capability to articulate well and being able to impress without being present in that room. a good somebody who can articulate his ideas well will probably also be good at execution, right? So there will be some level of correlation between communication and execution. So these softer aspects, when you put them all down in a deck and send it across, always measure how many of those approaches result into a call or into a meeting. And if that number is high, if it's a positive hit more than 20% of the time, I think you have a nice deck in place. But if it is, let's say, less than 20%, less than 10%, you need to work on your deck, because you should get more responses when you share your deck with somebody.
So, Kanchi, if I may just add and build on one of the points that Samarth made. I worked with a lot of startup investors where he was focusing on this answer. And where I understand the business, I work with them and they're writing the deck. And I tell them, but this you didn't bring out. Say, yeah, I'll talk about it. That is a big issue. Because you have to understand, Samarth just said it is the way of communicating to somebody where you are not there. A lot of people forget that this is the medium of communication when you're not there. All those aspects very crisply must be brought out in the deck. Please don't treat the investor as an idiot. He or she didn't get there because he or she is an idiot. I mean, you may have a personal opinion. We can talk with Samarth about his investors separately. You may have a personal opinion on that. But when you're communicating, crisply bring out the elements in a deck. As I look at the Q&A panel, there is Gagan asking, saying a lot of things go dead because they are on emails and they are happening. Gagan, I would strongly urge you to take a deep breath and look at it to say, are they going dead because you are unable to bring out the points that you wish to make? Either because, a lot of people I talk to, they say, wo page 3, para 10 mein dekho, ye ek line likhi hai maine. It is not about ticking the box that you filled in that line. If that line is important, it has to leap out from the page because it is important. That lesson in communication is very, very critical.
Thank you, Mr. Raman, and thank you, Samarth, as well. Many a times founders also ask, how do I know how much to raise, right? We'll get founders at different stages of their journey looking for different amounts. So, and many a times then, investors go and suggest, I feel this is the right amount for you after they study their business a bit more. So what are your suggestions on how much should a founder raise, and how should they evaluate that? And, for what duration should they raise capital?
So, Samarth, you want to go in first? You want me to go in first? I'll give my perspective, then you can add to it.
Sure.
We've discussed this point vis-a-vis your company a few times. See, I think you've got to have enough money to be able to do what you want to do, plus a little bit of a cushion. Because, you have to remember that Murphy lives in India. And Murphy's law is practiced every day in this country. So you have to plan for those contingencies. But if you have to set out on a task, but then you have to do it in a modular form, so that, let's say, with a task, you come out to say, I need to raise 10 crores. And then you're talking to some investor who's willing to invest, say, 6 crores or 7 crores or 5 crores, but not 10, in a modular manner to say, okay, this piece I will do later. But, it has to fit like pieces in your mind, and you need to have tremendous clarity first for yourself. And once you have that clarity, it will come out to the investor. So again, what I said to the earlier question, I don't believe in raising money for the sake of raising money. It is to do something You can raise the next round at a better valuation and dilute less. But you have to set your eyes on what task has to be accomplished, what money is needed, and in working out what money is needed, why various components. It is not only about hiring people, it is not about technology, it is not about the experience, the expertise, to lay out where that money would be utilized. That is what gives the comfort. There are times I get out of the meeting saying, this guy knows his marbles. That is the feeling the investor must get, because then he or she stops querying those aspects. And there are multiple times that some of us IN members, we met companies where we have a post-meeting call where we say, this guy really knows, or this lady really knows the stuff, and I'd love to be able to support it. Or 80% they know the stuff. Maybe in HR they are a little weak, maybe on technology they are a little weak, because okay, you can't be everything to everybody. And there are times you come out of the meeting to say, man, you're kidding that I'd invest with them? These guys don't know their ass from their elbow, excuse my language. So bringing that out, it is an opportunity of communication, and it is what you need to set out to do. That is what determines the amount. Now I'll let Samarth give you a greater insight to this perspective.
So basically, I'll say I would like to bring in the aspect of numbers into this, which is it's important when you're running a company, right, or you're aspiring to build one. Very important to know your numbers like the back of your hand. It's very important to have an intuitive feeling about the numbers of your business. You shouldn't need to have to go to an Excel sheet. You should know your numbers intuitively. You should be able to feel what's going to happen with what you're trying to build. That clarity of vision will enable you to put down your projections in an Excel. It will not take a long time. Once you put them down, those projections enable you to understand how much money you envision you are going to need. And obviously, like Raman was saying, keep a cushion, because things can go wrong. But usually in the early stages, people are able to raise funds for 2 to 3 experiments, right? So you would know what are the 2 to 3 experiments you would do in your product market fit, and how much is each experiment going to cost you, and how much funds do you need to be able to give some early successes in those experiments. Add about 20%, 30% to that, and that's the amount of money you need to raise for your idea to actualize, right? Now, that doesn't really mean that you will probably be able to raise that kind of capital in the market. So you need to add some realism to it as to how much equity you think you will have to dilute in order to be able to raise that money. Because if the amount of capital you need is twice the total worth of your startup right now, you're not going to be able to fund it. You will have to sell your company twice over. So it's a balancing act. How much money to raise, when to raise. It's a lot of moving parts. And one thing for sure is it doesn't really happen in a month or 2 months when you suddenly decide to raise funds. It takes longer than that. You need to build certain relationships. So while you're working on your numbers, keep meeting people and taking feedback. And I think that will also sort of give you an idea as to how the market is viewing your business idea. What kind of feedback are you getting from the market? And probably a good question to ask the investor when you are meeting him is, how would he value your company? Because that will give you a sense of valuation that you'll probably get in the market, and how much money you can raise based on that kind of valuations. So there's a lot of numbers involved based on the mathematics that you do on your projections and the valuations of your company.
Lovely. Thank you, Samarth. I guess now we can open up for questions. We have a lot of founders that are asking questions via the Q&A tab. So we can, we promised them we'll give them ample time. So I think we have a good half an hour for a Q&A round. So If you don't mind, with your permission, should we open up for questions?
Yeah, sure. Go ahead.
Okay, great. So I'm just looking at the questions. The first one, Samarth, if you could take, in your 5-year journey, when did you find product market fit and how did you know? What competitive advantages does your venture have?
Sure. So we actually were quite lucky to have found a very core problem to solve from the early days of our company. We are a company which delivers products to retailers, Kirana stores in India. And this is actually not my first startup. I started a company before this, which was a company that I was providing a B2C app to retailers, which will allow retailers to come online and sell Kirana products in their neighborhood, or sort of become a small Amazon in their own area, in the neighborhood that the retailer is in. Now that company I started in 2015, which I was within 6 months of launching the app, I was able to understand that there were some issues in Kirana stores being able to sell online, managing thousands of products on our app, and a lot of different issues we were able to figure out, which is what we use, that knowledge, that experience we use to pivot to the next experiment, which was of instead of enabling the front end of the store, we started enabling the back end. Based on our conversations with the retailers, we understood that the problem was not in sales. The problem was actually in the buy side, where retailers were looking for products that they can sell in their store. So this was my second experiment. Until then, I had not raised any funds whatsoever. I was bootstrapped, and my first experiment failed. Based on that was the initial amount of effort and money that I invested myself. I restarted. My second idea was to now start supplying to the retailers. And in the second idea, again, I started working on my own. During the day, I used to do my coding. During the evening time and night time, I used to do my coding. During the day, I used to literally deliver orders that were coming on my platform. First half of the day, I'll be doing marketing for my app. Second half of the day, I'll be doing deliveries. And by evening, I'll get back to my desk and start changing the code of my system based on the learnings in the market during the day. So I was a typical $99 startup, right? Where I didn't want to invest more than $99 in trying to get to an initial product market fit, and I would do small gigs, like I actually taught tuitions to be able to pay some bills and make some more money there. And I did a lot of these gigs to be able to sustain. But I got my product market fit. And that is when I met investors and felt comfortable telling them, I've got something here. Organically, the orders are growing. The time to sell my app in a store is now less than 15 minutes. Within a conversation with a customer, I'm able to make a sale. And anybody who installs my app doesn't uninstall it once I leave. Actually goes home and at night tries my app, and we start getting orders. So when all of these things started getting in place, that's when I came to know that the customers are using our app naturally without me having to push for it. And when that started happening, yes, we knew we have something here. We have a product market fit. And that's what led us to start meeting investors with a product in hand, which is working. That was in 2016. So like I said, I was lucky to have, in my second attempt itself, get an app which had a good product market fit. But yeah, we should always keep iterating. We should always keep pivoting till we get to that traction in the user base. Nothing proves product market fit better than organic traffic or organic growth. If you look at your user cohorts and you see sticky user cohorts for 2 months, 3 months, where users who were onboarded in month 1 are not leaving your app in month 3 and month 4, that's a good indicator of knowing that you have a product market fit. Even if it's being given at a certain discount, and then you could work towards trying to make some profits instead of giving it at a discount.
Lovely. Thank you so much. That was very inspiring. Mr. Raman, another question more from an investor's perspective. So the founder is asking, what is expected from a pre-revenue startup company with product readiness state to get the investment, and how is the valuation of the company arrived at?
See, if you are at pre-revenue, you have to bring out that your concept is fulfilling a need. All the companies, when they start, are pre-revenue. Whether you go to your dad or your uncle or your chacha or your taya or your auntie to ask for money, or whether you go to investors, you have to bring out why it makes sense commercially. This is not for emotionally picking up money. So you have to bring out that it is an idea that will work. It is an unfulfilled need. And again, I'll just take the two examples that Samarth gave. The need for the retailer to be a mini Amazon with the app is a need. It is a need even now. And he tested it, tried it, and said, by the way, because of the huge number of items, it did not work. So to be able to bring out the need of it, what is the valuation? It comes down to say what money will it take to prove the idea, to bring it to reality, to have real customers who will be willing to pay for your services. How much money does it take, and what you should be willing to give away, and work backwards to be able to work out a valuation. And if you're lucky to get some investors who can add value other than money. Don't get me wrong, money is good enough for a lot of founders because they have the understanding and expertise. But if you're able to get people who are in that field, who have that understanding, who can coach and guide you which way to do it, that is a value add. In the questions that I was scanning through, I saw somebody say, but I will be left with a small percentage. The biggest worry for the investor is that as a founder, you'll be left with a small percentage and you will hand the keys to the car, say, good luck, I'm leaving, you manage your problem, because the investors cannot run the company. So the mutual win-win is where the founders gain and so do the investors. And I can tell you, as a philosophy within IAN, we ensure that there is enough for the founders, not only now, but after the next two rounds, for them to be able to participate in the value that they have created. So valuation, will it be, 1 crore, 50 lakhs, 2 crores, 5 crores? It's very difficult to put a number, but then there are always guiding principles of similar companies in that world who've done that, because the need for money is somewhat similar to be able to prove the concept.
Lovely. Thank you. Thank you, Mr. Raman. The next question is more in terms of what is the IAN investment thesis. So they just want to understand how much capital do we invest and in which sectors do we invest in? So.
Okay, Samarth, I'll take that. IAN is sector agnostic. We invest in almost every sector. IAN is a facilitator. We are an angel network, and we facilitate the founders to create a pitch to be taken to these angels. That is the job of IAN and the secretariat and the company that I'm honored to be a co-founder of, where we take and work with the founders to take the pitch out, where some angel investors put up the hand and say, I understand this a little, I'm willing to work on this a little more and look at what can happen. What is the quantum? We typically would, the a typical raise for the companies is about 3 crores. We, again, as a kind of a glass ceiling, we look at about 7 crores on the platform. But I can tell you, I led a deal that was the highest ever deal where we did $3.5 million. That is about 27, 28 crores that we raised in that deal. So it depends on the nature of the business and what we are promoting. IN Fund, on the other hand, typically invests about $1 million. Again, the fund is sector agnostic. What we look for there, that is beyond the concept stage where there is some real revenue and what the founder is trying to do is proven and they need capital to take it to the next level. That is the investment thesis. We support IN companies and non-IN companies in almost equal manner.
All right, thank you.
I can go on and talk about this for 2 hours, but that may give you a little flavor.
Yes, absolutely. No, thank you, Mr. Raman. So like you mentioned, of course, it is 3 crores, but just to build on that, the investments on the network range all the way from 25 lakhs. So we close rounds that are, for founders that are in their very early stages and need to raise a smaller round to begin with. It starts with 25 lakhs and it goes all the way up to 7 crores on the network. And then, of course, the fund follows that up with where the network leaves off. So upwards of 7 crores is where IN Fund participates. So
in fact, just yesterday we closed an investment, I think, of 25 lakhs. I'm just looking at the app. We use 27 lakhs. Hire a Camp was a company that raised 27 lakhs yesterday. And we raised it in about 38 minutes. We've had rounds up to 5 crores. And we've raised money up to that when we take it to our angel investors within half an hour. But that is what Samarth was talking about. That is the power of communicating. That is the power of the pitch. Because before the founders pitch to IN stakeholders, their pitch goes out to them. If you're clear about it in the pitch, more people log in to hear your story. More people have queries and questions. And when you open the deal, more people come in and invest.
Fantastic. Thank you so much. Samarth, maybe if you could shed some light on, just a moment. So in terms of when you were raising capital, what was the time duration that you saw and how well in advance did you decide that, okay, I need to leave so much of a buffer before money would hit my bank? So when did you start your fundraising journey with Max Wholesale?
Well, when you're building a startup, almost there is actually nothing that goes according to plan. It's like, there's a famous saying, it's like building a plane while flying it, right? So you can't really, there's a lot of execution needed, a lot of listening to your inner voice and acting fast, making some quick decisions, but always finding out a way to get to the next day till you achieve your goal. And don't just, for example, you have a plan that you will go to market, you will raise funds in X number of months, but that can easily become twice that much amount of time. So if you think you would be raising funds in 3 months, it's highly possible that you might end up spending 6 months raising funds. So what do you do in that situation? A founder should be able to find creative ways to get to the 6 months instead of just giving up in 3 months. So there's a lot of grit involved. There is a lot of flexibility is needed. You need to be always quick on your toes, creative, and find the best solution given the situation that you have and the assets and the liabilities that you are sitting on. Always be creative, find a very good solution to reach to the final goal, and keep executing, just don't give up. And then you will see that your hard work will give benefits, and you will be able to reap the rewards of that. You cannot have a plan and then not be ready to go away from the plan. It's the name of the game is improvising, on not just on a daily basis. Sometimes during the day you have to improvise on an hourly basis. There are very dynamic days while you are executing very fast. So it's important to be flexible, and it's okay to divert from the plan and execute something different based on the changed environment, the changed scenario that you find yourself in. So constantly keep evolving your decisions, and then you'll be able to, if you're able to survive that, I think that's the best mantra to be able to get to the finish line.
Fantastic. Thank you, Samarth. Mr. Raman, now there's a question more from an IN perspective in terms of, as an investor, does IN look at, so there are two questions which I'll combine and ask. Firstly is, do we invest only in young entrepreneurs, or is age, do we look at the age of the founder when we're investing? And the other question is, the founder is saying, how can I grow my startup while living in a small town? Does IN fund startups from Eastern India? Is it necessary for a startup to fit into the regional ecosystem? How is it possible for a startup to get funded by foreign investors, and what are the factors the founder needs to learn before seeking to the investor? So you've covered the second half of the question in terms of what factors the founder needs to learn, but just the first half, one in terms of the age of the founder, and do we look at founders from small towns in Eastern India?
Well, as IAN, we do not. I mean, we wouldn't be having sleepless nights over the age. Again, let me use different words to talk about what Samarth said. He tried his hand at a startup and not succeeded. People who've tried their hands, not succeeded, and are honest enough to acknowledge that they tried their hand and did not succeed, and bring out the reasons why they did not succeed. And the reason can't be because I didn't get money. I mean, that is, yeah, ultimately you didn't get money, but you didn't get money because something else happened. गाड़ी स्टार्ट नहीं हो रही है क्योंकि बैटरी डाउन है, पेट्रोल नहीं है, धक्का मारना है, गाड़ी पंचर है. What is the root cause of it, that particular aspect? Again, I was asked this question not vis-a-vis IAN, but the age for a startup. And I don't know how many of the attendees have heard of a gentleman by the name of Ashok Soota. When I set up SpectraMind, Ashok Soota had left Wipro and started a company called Mindtree. And I mean, not that I was that young, but he was much older to me. And that Mindtree, those of you who follow IT companies would know, did phenomenally well, and he left. And a few days ago, he started a company, I think, called Happiest Minds. His IPO was oversubscribed 150 times. He's 72 plus. I mean, how much plus, I don't know. So, it is the quality of the idea, but so let me now twist this around. The quality of the idea, it is also about the passion. If you are looking for a 10 to 5 job, okay, I'm not looking for 10 to 5, I'll work up to 7. If you are looking for a 10 to 7 job My honest advice to you would be stay in your job. Entrepreneurship is not for you. If you're willing to be possessed by an idea, where you eat, drink, live, breathe what it is that you have to do, if you are that passionate about achieving the goals of what you have to do, and Samarth and I have a very close view because I sit on his board. During COVID, these guys were running around like chickens, headless chickens, trying to say, but it is an opportunity. Not because they were taking risks. I mean, it is not. Hopefully they followed all the norms and everything, but they see it as an opportunity. You could see the passion. I still remember my first meeting with Samarth. I don't know if he remembers it. We met in our office in
I do.
Gurgaon.
Yeah.
And I got out of the meeting to say, isko to main nahi chhodunga. Because there is a passion, it comes out if you're not passionate. So another thing that some of the other co-investors and I were talking about, where investors come and say, main paisa laga raha hu. So one of the investors who's been an entrepreneur before said this to me. वो बोल रहा है मैं पैसा लगा रहा हूं. I hope everybody understands Hindi, those who are attending. वो उसको बोलो वो पैसा लगा रहा है, ठीक है, मैं जिंदगी लगा रहा हूं. That is the passion that has to come out. And when you have that passion, age, in my opinion, becomes irrelevant. Experience becomes an asset. And that is what people have to work on. The quality of the idea, quality that you have to test out, quality where you interact. Look, just again, I'm playing back one entrepreneur's word because we have the luxury of him being on this panel. Samarth just said when he goes to the guy, he hears what he has to say, he gets him to download his app, he explains about his app and he leaves. And maybe earlier they were deleting it. Then he monitors whether they are deleting it. Now not. That is what the entrepreneur lives by. And when they bloody delete it, he or she goes back and says, साला काय को delete किया, मैंने क्या गलती किया, मैं सीखना चाहता हूं. So the passion is very important. Age is a number. And in IN, we believe with that.
Thank you. Thank you so much, Mr. Raman.
The only thing we don't believe in is being called Mr. Raman, but that's okay.
The next questions more in terms of equity. So I know we have a separate session detailing on valuations, but if a founder has raised 66 lakhs for 75% in early stages and now it's grown and looking to raise 5 crores, what would be the investor interest for looking at such a cap table?
Sorry, was that to me? Your voice dropped in the middle.
I'm sorry, I'll repeat the question. It's more in terms of valuations and cap table. If a founder has raised 66 lakhs for 75% in their early stages and now have grown and looking to raise 5 crores, what would be the investor interest for looking at such a cap table? And then I'm sure you'd like to give some.
It's not a good cap table to have raised a minor amount and given away 75% of the company. And if the products of the company are any good or anything, and if I was evaluating such a company, I'd go to the existing investors and sit down with them and say that you need to relook at the number of shares and what percentage stake you hold, because that is the only way another investor will come in. If the existing founders go down beyond a particular limit, they won't care. We don't want founders who don't care. But 75% of the company being given away to raise a minor amount to prove a concept, I wouldn't say it doesn't occur, because a lot of founders make, while giving even a 10 lakh rupee check, make people sign things, and then they turn around and say, but that is what you signed and all. They are uprooting little saplings that could potentially become a tree. And with their actions, they uproot those saplings and they die, and their investment dies. So I would encourage a dialogue between those investors, the founder, to relook at, recast the cap table, and then get in incremental investment. But investment in a cap table where 75% is gone, and the concept is not proven, and there are no real customers, and you need 10 crores where you raise whatever 1 or 2 crores, whatever you gave in your example, it's not very smart.
Thank you. Thank you, Mr. Raman. So clearly there are solutions out of it, but it's just a matter of dialogue with the investors. For them also to get a further on exit, they would be open to something like this, because eventually it will help them when the founder raises the follow-on round subsequently. So
Yeah.
It's not the end all. There are ways out of it. We just need to.
There is no, for entrepreneurs, there is never an end all. Entrepreneurs do not give up.
Yes.
And again, Samarth said earlier, we will find a way. Entrepreneurs find a way. Whether they take a haircut, they take a salary cut, they take a family cut. I mean, a lot of entrepreneurs build their companies at the cost of a lot of their personal lives. It can't be put in rupees and paise.
Thank you, Mr. Raman. Samarth, a question for you, because I know Mr. Raman did cover it, but maybe you'll give an unbiased opinion, so the founders also convinced on this. They have a question on, does fundraising result in losing decision making and freedom on how a founder wants to take the company forward? And what has your experience been with investors?
Well, you have, I think, a good company is managed and run by its board, and it's important to have a good board. It's not a one-man show. You can't go very far as a one-man show, right? And it's important to have investors you believe in, just like an investor who wants to invest in an entrepreneur he believes in. It's important for the entrepreneur to work with an investor you really believe in. And an investor's guidance, it's invaluable. You are, as an entrepreneur, busy executing your vision. You are too close to your own execution. You are just engrossed on a day-to-day basis as to what are the daily problems, or the next 6 months problems, or the next 1 year problems for your company. You are executing that vision. It's very easy to sort of not get the time or lose focus on what else is going on. Whereas, your investors are interacting with other companies, they are in the market talking to other founders, or in general have more experience than an entrepreneur does. And that should be used to your advantage. It's important to be able to listen to, there are very good, so investors are your team members. That's how I look at it. I think the investors are your biggest supporters and your team members, and it's good to listen to them. And if the majority is deciding against what, as an entrepreneur, your individual decision is, one should be comfortable, running the company that way, because it's the rule of majority that is usually the best for the company. And if you want your investors to give you a free hand in terms of decision making, it's something that an entrepreneur has to earn. It takes some time to earn that kind of confidence and trust with your investors by showing good execution, responsible execution, discipline, and there's a lot of softer aspects which it's like building a relationship, and once that happens, I think while you are giving away equity, it's not always that the last thing that the investor would want is probably to come in and run your company for you. That's something that the investors would never want to do. So they would like you to run your company. They would like you to make your own decisions, as long as you keep their trust and give some victories, execute well. It's a good thing to have sounding boards in your company, and good investors do that very well.
Okay. Thank you, Samarth. Okay, Raman, last two questions because we're running out of time. One is, I've seen this from many founders on the chat right now. Is traction a must for IAN in order for them to fund a startup?
So let me start by saying the reverse. Lack of traction to say we tried, tested, nobody wants to buy our product, but please fund me. That doesn't work. But I have yet to do a check on it. And, we have people with the collective experience within IAN are 500 to 600 all angel investors. Is more than 1500 years. We'll always find somebody who has some understanding of that field and is able to say, that sounds like a great idea, or to say, oh, that ain't gonna work. And be able to engage with the entrepreneur, not just to give a decision, be able to engage and talk about it. So traction to be done, how it will be done, how we will test it out is as important as traction being done if it has not been done. But yeah, at the end of the day, a business needs to have customers. Look, I don't recall IAN funding even a single company that was registered as a charitable trust. We are not in charity. A lot of our members do charity, but they do not use the IAN platform to do charity. You need the business. Business has to have customers. Customers have to bring in revenue. The marginal cost of producing the good or service has to be lower than the revenue so that it is profitable. Those are the basic thesis. Now, there may be people who come in and say, right now, I'm selling at a loss, but later I'll sell at a profit and be able to bring that out. Is that acceptable? Yes, it is. But that is not the norm. It is more an exception.
All right. Thank you, Mr. Raman. We're running out of time now because it's 5:13 and we had to close at 5:15. So thank you so much. It was a fantastic session. Thank you so much, Mr. Raman and Samarth, for your precious time and for such an insightful session. It was great that the participants got an opportunity to hear from both, an investor and a founder on your respective perspectives on fundraising. So a big, big thank you once again. To all our participants on the call, thank you for joining in. Our next session is on the art of pitching on Friday, 8th January 2021. So after you've sent your pitch deck and you have an opportunity to then go ahead and present to an investor, how do you go ahead and pitch to them? So it'll cover that. I'm sharing the registration link in the chat box below. So please feel free to register for the session. And of course, in the meantime, if you do have any questions and are looking to raise capital, you can send your decks across to me. I'm available at Kanchi at indianangelnetwork.com. And I will be sharing that in the chat box as well. So yeah, that brings us to the close of this session. We're looking forward to hosting you next, on the 8th of Jan. And in the meantime, I hope you have a wonderful weekend and a fantastic holiday season.